I'm Brett Leboff, and I have Mark Palmer on the line. He is a partner at Hamilton Court FX. Mark, I just wanted to ask you a couple of questions. We've all seen the euro area underperform in the last few years, but it's a big trading partner for the UK, particularly in the automotive sector. What are the problems UK companies could face, do you think?
Well, I think the problems UK companies have got, I guess, are twofold. From an export perspective, if you're shipping goods over the course of the next few years into the Eurozone and their currency is depreciating and you're priced in sterling, then your goods become more expensive, and therefore you might be left open to competitors within the Euro bloc that are offering the same products or similar products to your customers, but at more competitive prices. I think if you then flip that around from an import perspective, you've got the opportunity to import goods from Europe at continually lower prices, but if you're then hedging yourself, does that hedge leave you beholden to exchanging in currencies at less beneficial rates? And then your domestic competitors, who maybe haven't been as prudent and have hedged their FX requirements, are able to buy at a spot market. They're getting their goods effectively at a cheaper price and may be able to undercut you in the open market. So it really depends which side of the fence that you sit, but there certainly are problems and benefits on both sides that need to be considered.
So how would you say a company in the automotive sector with long-term contracts would protect themselves?
Well, I think if you're importing from Europe and you have got long-term contracts in place, either with a tier one or a manufacturer, I think actually looking at the contract and making sure that there is a currency clause in there is going to be the first port of call. I think if you're dealing with a tier one or a large manufacturer, then you are going to be dealing with a sophisticated seller, and they are going to expect some kind of clause in that contract. And it just gives you the option then to renegotiate terms if we do see a significant depreciation in the euro over the course of the next 18 months. But of course, with significant depreciation also comes the opportunity for the euro to stand to gain a lot when they do get their problems in check. If you look at pre-crisis levels, euro versus the dollar was up at sort of in the 160s, and euro sterling has been down, or sterling euro rather, has been down in sort of the 110. So there is an opportunity for the euro to strengthen back. If you want to hedge yourself out for the contracts that you've got in place, then do it on a contract by contract basis so that you know that the FX rates that you'll be paying per contract. And if there is an unknown quantity in there, then perhaps average out your hedges by placing 50% on forward contracts and leaving the remaining 50% to the spot market, or when it looks prudent to gradually top up the remaining 50% by booking forwards.
Thanks very much, Mark. That's really useful information.
No problem. Thanks, Brad.